In this video, I'll be sharing some of the worst finance mistakes pretty much every investor makes at some point, myself included. In fact, I wish I really knew about these things when I started looking into property investment over 10 years ago. Because if I'd known them from the start, I would have made better investment decisions without so many challenges and hurdles along the way. Mistake number 1 is ignoring the numbers. People can skip crucial calculations when it comes to making a property purchase. You need to make sure you run your numbers, looking at all of the income and all of the expenses, including breaking down vacancy rates, looking at costs for council, water, other types of rates, mortgage fees, interest, principal and interest payments, and how that affects your cash flow. There's so many things you need to unpack when it comes to making a property purchase. Another thing I see quite commonly is people overlooking hidden costs or underestimating areas that they didn't know they'd need to spend money. Maintenance budget can be a great example of that. People might buy a property with a lot of deferred maintenance, but then they need to come back and spend thousands and thousands of dollars to update the property. Now, when Emily and I bought our first home, we actually did account for these hidden costs. Now, thankfully, I'm a chartered accountant, so I love running the numbers. It's something that I've done every day over the last 10 years. And so this is an area I have made mistakes in, especially our flip project. I underestimated some of the costs in our flip project last year. But over our investing journey, I've been very detailed in running our numbers because I am a chartered accountant and I want to make sure we're getting it right. At the end of the day, property is a game of finance. We're more worried about the financial outcomes and the choices that we're going to get from property investing rather than just buying an investment property and hoping for a great outcome. Now, you're not going to get your numbers perfect first time or every time. You do need to make calculated and educated decisions when running your numbers. I actually have a free property investment calculator that you can download off of our website. So head over to purposeproperty.com.au to download that free property calculator. You can sit down and run the purchase price, all of the associated costs, and then take a look at your profit and loss, looking at the income and all of the associated expenses when it comes to owning a property. This leads me into mistake number 2, which is emotional purchasing. People can be emotional whether it's an investment or whether it's their own home. Now, a lot of people tend to think that it's the homeowners that do get overly emotional and do pay too much for property. But you'd be surprised how many investors are jumping onto market trends, looking at properties every week and getting tired and sick of the process. And they've gone to 5, 10, 50, 100 open homes. And investors do get dragged down by the weight of actually looking to try and find their next investment property. And what can happen is when they do find a property, they can get emotional and they can overpay. This does happen with homeowners as well, of course, where they see a property and it's beautifully presented and it's the floor plan that they love and it's the area they love, so they'll pay $100,000 over the rest of the market to secure that home. Don't let your heart overrule your head unless you're fully aware that you are making that decision. Emily and I are currently doing a massive renovation project here on the south side of Brisbane in the suburb of Greenslopes. We're spending roughly around $600,000 at this point in time to complete our raise and build renovation project. Now, in my point of view, that money needs to make sense and give me a return on investment, both from an investment point of view and from a heart point of view. So try and align your interests and your desires along with your numbers, like we spoke about in the previous point, to make a sound investing decision and not let your emotions take over. Oh, unless your wife really loves the place, then just pay $100,000 more. Okay, I said it. Let's leave it at that. Now, mistake number 3 is being a cash flow cowboy. I've heard of cash flow strategies over the last 10, 15 years, and there's a lot of YouTubers out here that talk about cash flow is the only way to go. You need to buy cheapy properties, get lots of cash flow, make sure you're buying duplexes or dual locks, and chase the cash flow before you chase the growth. I think this is a major mistake if you are just chasing cash flow and prioritizing it over growth. In my opinion, it should be the other way around. Obviously, it depends on your circumstances, but for the average Joe Blow who's looking to buy an investment property and build their asset base, generally you're going to need to create growth first, then leverage that growth by refinancing, pulling out the equity. Yes, you're going to have more debt, running your numbers, and then looking to transfer to cash flow assets over time. If you buy a cheapy property, the aircon in that property versus $1 million home is going to roughly cost the same. The painting should roughly cost the same. The flooring, depending on what you choose, should roughly cost the same. So those cheap properties can actually hurt you in the long run when you have a maintenance schedule pop up and when you need to do repairs on those homes. Also, cash flow properties tend to be in subpar locations when they're spruiked to the everyday investor. The classic cash flow properties, buy a property in the suburbs. I can think of Brisbane, Caboolture, Ripley, Yarrabilba. Buy one of these brand new properties. It'll give you depreciation benefits. It'll rent for $650 per week, and it's only costing you $550K or $600,000 to buy. So it's got a really strong yield relative to those established properties over there. Now, the trick with that is that it catches people because these areas are going to have a lot more land supply, and you're typically getting less land value and less house, and therefore you're getting a higher rent. So when you compare the land value and the house value, you have a lot more house in these areas and a lot less land, hence why the rent is a lot higher. You might need to replay that again to actually let that sink in, but if you have more building on the property, that means you're going to get more rent, but less land value means less future potential growth because land does a lot of the heavy lifting. A lot of people say, and I probably say the same, it's about 80% of the heavy lifting when it comes to long-term capital growth is the location. So there's absolutely a time and a place to buy and own cash flow properties. It just depends on your circumstances. But the big mistake here is prioritizing it over growth in your property portfolio and not being able to leverage and build the asset base you need to get the compounding growth or to move that equity into cash flow assets to give you more choices. So I personally like growth first and then cash flow second. And that's what Emily and I have done. We've got growth properties. We bought 3 houses here in the Brisbane market, and then we decided to go for a cash flow property by picking up a unit block in Coffs Harbour, which rents out across 5 dwellings there, so it has a much stronger cash flow. So take a look at your own property portfolio and your own plan and see how you can balance capital growth and cash flow in your journey. Now, mistake number 4 is falling for location hype. People are hyping up hotspots, locations here, cities there. There's always a new hotspot to be buying a property. It used to be the investor magazines, then it was the newspapers, and now we've got YouTube to speculate on where the next hotspot is. Now, those videos do perform really well. So of course, people are going to bring out that type of content if that's what people are clicking on. But don't chase the hotspots. Yes, you need to plan and you want to look at short, mid, and long-term growth of locations. You want to plan out your portfolio and how you can refinance equity and then go again on your next property purchase. But don't purely speculate or follow the market to find your next suburb or your next property. There are markets that can be driven by investor sentiment. I think there's some of that happening across Australia at this point in time. There are some spruikers out there selling some hotspots, which are their own developments, or they're getting a kickback of $30,000, $40,000, $50,000 for getting you into that property. Back in the day, it used to be the mining towns, and I personally know people who got caught up buying multiple properties in those areas only to see them crash by 50% in value in a short period of time. So don't be caught chasing hotspots. Look for areas with short, mid, and long-term growth potential. Now, one of the things I like to do is actually be able to pull levers. I want to buy an area with some strong short, mid, and long-term growth potential from a capital point of view, so capital growth. But I also want to be able to manufacture value in the short term through a cosmetic renovation to fast-track my equity creation and to allow me to refinance that property. In the mid to long term, I want more choices and options with my investments. So I might buy a property on a larger block with granny flat potential or with subdivision potential. So in my opinion, try and pigeon pair your properties with multiple strategies, and that's a way you can almost not guarantee growth, but give yourself more choices and more options to pull those levers and to grow your property portfolio faster. So don't be caught hotspotting and make sure you're making an educated and an informed decision. Massive mistake number 5 is inaction. This is the biggest killer when it comes to property investors and homeowners when it comes to getting into the property market. You could watch You know, how many videos have we got now? 500 YouTube videos from myself and other people out there. You could read as many books and listen to as many podcasts as you want. But without taking action, you're not going to see any reward. There's a quote out there that says, imperfect action is better than perfect inaction. Now, you can surround yourself with a team of professionals to help you through this journey. You can work with buyer's agents like myself, deal with mortgage brokers, deal with accountants and property managers, or you can try and do all of that yourself. You can not use a buyer's agent. You can self-manage the property. You can do your own tax returns. So you can do this all on your own or with professionals. So in my opinion, work out who you need in your team, build out your professional team if you feel like there's value there for you, and take action. Emily and I got started. We saved. That was our first goal. So let's start saving for a deposit. Once we hit that goal, let's start chatting with brokers and banks. And we dealt directly with CBA for a large period of time as we built out our property portfolio. And as we become more advanced, we've dealt with more mortgage brokers and we've worked with different accountants and we've got depreciation specialists and different property managers. So your team will change and build out over time. If you are looking to buy a property here in the Southeast Queensland market, whether it's your own home or an investment property, we can absolutely help you do that. So head over to purposeproperty.com.au to book in a free strategy session with myself. Action is going to speak louder than words. And whether you need the professionals or whether you can do it yourself, if you can take action and you've got that long-term investment horizon, because in my opinion, property is a long-term game, then you're going to give yourself a much better chance of being successful than sitting on the sidelines and doing nothing and letting inflation eat away at your hard-earned cash that you've been trying to save to break into the market. So, have you made some of these finance mistakes along your investing journey? I'd love to hear from you down in the comments below. And if you want to see me break down and even share a bunch of property addresses for some recent client purchase examples here in Brisbane, click this playlist over here. I'll see you in the next one. Peace. There's a quote out there that says imperfect action is better. There's a quote out there that says imperfect action is better than perfect inaction.